Hey everyone, hope you're doing well and getting ready for the warmer weather. I've got kind of the Lex Luthor thing happening today. I wanted to talk to you about a mortgage term you're going to start seeing more or hearing more, and that's underwater mortgage. Now, this is an important term to understand because an underwater mortgage is something that particularly is happening with variable rate mortgages or a specific type of variable rate mortgage where they had static payments, but the rate would fluctuate, and it meant that more of your payment was going towards interest than paying down the principal. Now, when these mortgages happen, when the rates go up, it actually pushes out the amortization. It extends your amortization out past the 25 or 30-year term you started with. And as a result, there's a lot of mortgages out there. Somewhere between 50 and 75% of the mortgages, the variable rate mortgages that were done by the big five banks, are sitting in this situation where the amortization has been pushed out so far that if it were to be pushed back into the original 25 or 30-year term, you actually owe more on your mortgage than what the house is worth. Now, this is due to a combination of things. And it's not just these mortgages. There's also high ratio mortgages where people only put 5% down and then had the mortgage insurance premium tacked on top, all of that stuff. So where we saw properties drop anywhere from 10 to 15% in value from late 2021 through to, late 2022, there are situations where now the property value is lower than the amount you owe on your mortgage, and these are called underwater mortgages. It's a concern right now for the government or for the governing bodies because they're really not 100% sure how much exposure these big five banks have with these underwater mortgages. And it does mean that the people who hold them are susceptible to being hit with trigger rates or one-time increases, where everybody else who had an adjustable rate and their payments went up gradually when rates went up, these people are going to get hit with massive increases all at once just to try and get things back in line so the mortgage isn't underwater. So this is something that's of a bit of a concern. However, reach out to your clients if you're a realtor, if you're an investment specialist, things like that. Reach out to your people to find out what exactly is, or have they looked at their mortgage statement, particularly if they're with the TDs or the RBCs and they had these static variable rate payments, because they could be in for a shock. And the good news is there are many lenders out there that are allowing people to switch and trying to mitigate this underwater mortgage risk by either re-extending the amortization for them, extending the debt ratios and making a debt ratio exception if they had to, allowing them to make the transfer while they cover things like legal costs, or allow them to bump up their mortgage by $3,000 to help offset penalties, things like that. So if you have any questions about it, feel free to reach out to me. You know how to get a hold of me. It's jamie@mortgagejedi.ca, and I look forward to chatting with you soon. Cheers.